Hi, and welcome to the Stock Scores Market Minutes for January 18th, 2016. This week's topic is how to profit from market corrections. Of course, we are in the midst of one, and I've gone over this many times in the past, but I thought I would reiterate some of the vehicles that you can trade to make money from sharply downward moving markets. Market corrections really present a rare but exceptional opportunity for profit. You see, volatility is high. And that while the direction is down, there's all kinds of exchange-traded funds and exchange-traded notes that go up when the market is going down. Now, it's important to shorten your time frame for trading because there's an old saying, the market takes the stairs up and the elevator down. The downward move is quick and sharp, and therefore trading off, even off of a daily chart, can often be too slow. I like to trade off of the intraday chart. Day traders will trade off the 2-minute. You can do the 13, the 30, even the hourly is about as long as I would go because the market does tend to move very quickly up and down as it generally moves down in a correction. Now, a number of things that I will trade during a correction. Of course, there's the VIX, the VXX. You can leverage that with the UVXY and the TVIX. There's the SDS, which is an inverse of the S&P 500. I'll show a chart of that in a moment. It goes up when the S&P 500 goes down, but it does so at roughly twice the pace of the downward move in the S&P. QID is the similar vehicle on the NASDAQ 100. In the Canadian market, we have the T.HSD, which is an ETF that goes up in Canadian dollars when the US markets go down. So there's lots of different vehicles to trade off of. And these inverse sector ETFs are also available. What I recommend you do is do a Google search for inverse ETFs or inverse leveraged ETFs. There's lots of them out there. I've highlighted just a few of them here. There's way more than that, although those are the more liquid ones and the ones that I like to trade. All right, so let's take a look at a chart of SDS over the last week. And the reason that it is lucrative to trade these things is because during times of market panic, there's lots of volatility, both day to day, like we had from Thursday into Friday, but also intraday when you get those big swings that happen during the day. So what I like to do is just monitor these things, look for breaks of trend, look for a little rising bottom, break of rising bottom, be a buyer. Here's a little break of an ascending triangle, be a buyer. Up in here, you had a little break of a pennant, be a buyer. That eventually broke down. I went long here. Probably broke even or lost on a few trades there, but then went short for the next move down. Little flag pattern and a breakdown, and lots of opportunity to take profits as the money or as the market moved to the downside. Then on Friday, it was a big gap day, and actually I don't like those big gap days because it takes a lot of the potential for intraday move out of the market. And so after a big gap, anytime you get a big gap like this, you want to be a little bit cautious and wait for a pattern to build. There was a pattern that built right there with a nice little breakout for a nice day trade there. And then we had a falling top, break of the upward trend line from a falling top. That's a cue to go short. Into the close, the market was able to gather a little bit of strength. Now you can monitor charts like this one to then do the trades on individual stocks as well. So, I'll short Apple, I'll short Microsoft, I'll short Intel, I'll short JP Morgan, any of the large cap liquid actively traded stocks. When I see a breakout on the ETF or maybe on the sector ETF, I might go long the stock because they'll tend to move with a little bit more intensity than the actual ETF. So if I see a breakdown or a breakout on the energy ETF, XLE, well, then I might go long one of the energy stocks. This week on Friday, I bought Marathon Oil, for example. ExxonMobil, I traded many times this week. So that's another way to take advantage of this great volatility, because what it really comes down to is you get more reward for risk. If you buy this here, look at the reward for risk that you're earning, 5, 6, 7 times on that big move there. And that's how we make money as traders. All right, let's get into this week's analysis. Here is the chart of the S&P 500. It looked like it might, try to make a little bottom here when it broke the downward trend line. But one of the keys is that it did not do so from a rising bottom. Now later that day, it made a rising bottom and broke. So that was a pretty good sign that the market was going to go sideways or perhaps go up. And that was my call on that day, as I thought that the market would go up here as long as the lower boundary of that channel wasn't broken. Well, the next day, which was Wednesday, the market broke that lower boundary of the channel. Now you got to switch back to being a bear. because now we're back into the bearish trend. The only thing is the channel has changed intensity. So what you do then is you now draw your channel like this, and now the market's deviating in and out of that. So as it stands right now, we're at the bottom of that channel. That means we probably move up into here on Tuesday. Of course, the markets are closed Monday. But what's important to recognize is that we are still in a downward trend. So as a trader, as a day trader, we may be able to make some money on the long side early next week, but ultimately you want to remain pessimistic. This is a bearish trend right now because the trend is down, falling tops over time. So generally be pretty careful as a buyer of the S&P. Longer term, and this is the real important chart, is here's the 5-year trend. We've had that trend line touched many times, did so in August on the correction in August, but it has now, and it really did it last week, broken the upward trend line. I wanted to give it the little bit of the benefit of the doubt last week, but it failed to hold. We are well below the trend line from a falling top. That points to more downside in the weeks and months ahead. So I think this is probably more than just a quick little correction that's going to pop back. There will be pop backs along the way. It won't go straight down. Typically, we have this pattern which goes like this. There's the break of trend from a falling top, and as it goes down, it'll meander down like this. And so you can be a shorter up here when it comes to the downward trend line. Sometimes you can be a buyer in here when it's just rebounding from being oversold. That's the way I like to trade these markets. However, this is a bear trend setting up, so be very cautious as a buyer. Same can be said for the Russell small cap. It looks like a little head and shoulder pattern here. There's your shoulder, head, shoulder. Here's your neckline. Broke the neckline last week. Now we're getting follow through. Market getting oversold, so don't be surprised if we move up a little bit before we move back down again. Here is the TSX, the Toronto Stock Exchange, which has really underperformed quite dramatically in the last couple of years because of the weakness in oil. Well, it also is in that downward trend, falling tops continue to be the course here, and so therefore in a short-term chart you want to be bearish. It also tried to make a little bottom there, but it remains a bearish market. Now oil was showing some signs that it was trying to make a bottom at the end of this week. It's got a lot of work to do, but that will help the Canadian market if it does. So that's the key thing you want to watch for. Now on the longer term chart, and this is the weekly chart, there's our downward trend line. We're way below the downward trend line. We're at the bottom of the channel. That sets up for a short-term bounce back short-term, but it is still a bearish trend long-term. So don't be surprised if next week you get an opportunity to buy the bounce. If you're a day trader or a swing trader, you can make good money on those bounce backs. It doesn't take long, a few days usually, but that is something to watch for. Now we are nearing that long-term support, which is roughly $17 on this market, but it's got some ways to go before it gets there. I think it bounces a little bit before and then probably goes back to retest that price zone. All right, next chart, the TSX Venture into new lows. Gold kind of rolled over this week. It had been getting a little support. This market had been getting a little bit of support from gold earlier this year. This is the daily chart, but it has not been able to hold the lows, and we're still in that falling top cycle. This market's just been absolutely decimated. If I went way back here, you would see just how far down this market is. Heavily oversold, but certainly no sign of a bottom yet. Do not be a buyer of these stocks in general. Now, because of the market turmoil, people rush in for the safety of U.S. Treasuries. That's why we're getting that little pop higher. If price goes up for Treasuries, that means interest rates go down, so it's cheaper to borrow, and we're getting a little pennant break right now. That points to Treasuries, bonds going higher. Again, if the market corrects, like I think it will do so further, maybe not in the next week, but looking out weeks or months, I think the market goes lower. That's going to drive Treasuries higher as people look for safety. The U.S. dollar, of course, if interest rates are going down, makes the U.S. dollar a little less desirable, and that's good for things like oil and gold. We didn't really see much price movement to the upside this week on the U.S. dollar, but we didn't really see much to the downside either. It is a safe haven currency, and we may see this upward trend break. We have built that falling top here. I would call this a neutral chart. I think you can call it either way. It's basically in a pennant. We got to watch, does it break up or does it break down? That'll determine where this market goes next. Gold, tried to make a little rally last week. As I said last week, that's a day trader's rally, maybe a swing trader's rally. Not much more than that. We are still below the downward trend line. We are in the downward sloping channel, about in the middle of the downward sloping channel. So it's not really overbought or oversold. It's just plain bearish, and therefore don't take a long-term bullish view with gold. Now here's the chart that I find interesting. It is the oil chart. It is, of course, ugly if you are a bull, but it had a little bullish engulfing candle at the closing day this week on Friday that put it slightly up, amazingly enough, and it was actually slightly up on Thursday as well. So we could see a little attempt at a bottom here. Again, I think it's at most a trader's bottom, something like what we saw here. There was another one earlier in 2015. These little trader bottoms, you know, for the day trader, swing trader, you can make, I remember on this one, 20 to 30% on some of the stocks because they're so oversold as the shorts come in to cover, as bargain hunters buy. Some of these stocks that were $30 that today are $3 might pop to $5, might pop to $4. So as a short-term trader, that's what I want you to watch for. Look for the old pattern that determines a bottoming. So if we're cycling down, we break the trend, step one, we build a rising bottom, step two, and we break from a rising bottom. That's what I want you to watch for on oil and energy stocks next week because it could certainly happen. VXX, the fear index, there you can see fear is on the rise. It has been moving higher. I love to trade the VIX. I've been trading it all week. Lots of volatility in it. You can trade the inverse of the VIX too, which is XIV. You know, days like this when we get the VIX selling off, that means the XIV is going up. But because of the volatility in the market, these are making big moves. The VIX was moving 15% in a day, or the VXX was moving 15% a day on some of the days this week. So those are big swings. You can take advantage of them if you are a short-term active trader. So my ratings: bearish on U.S. stocks, short and long-term; bearish on Canadian stocks; bearish gold long-term. I put neutral short-term because it is kind of bouncing around sideways in the last little while. Bearish on oil. However, all of these things are heavily oversold. Investors are panicking, and that means prices get pushed down too far. There is no sign of a bottom yet, but the correction creates opportunity. Say that to yourself. Corrections create opportunity. Watch for a change of momentum. That little pattern I showed you, break of a downward trend, build of a rising bottom, break from a rising bottom. Those are the patterns you want to watch for as a change of momentum. Wait for the bounce. Don't try to anticipate it, but it will come eventually. And even if it only lasts for 2 or 3 days, you can make good money on the upside if you're an active trader. If you're a long-term investor, stick on the sidelines, sit on your hands, wait for things to pan out. That has been the Stock Scores Market Minutes for January 18th, 2016. Have a great week in the market and trade well.